Good morning, everyone. I'm Lisa Pearce, Head of Distribution and Marketing at Totus Capital, and thank you for joining us for this semi-annual investor webinar. Today, the portfolio managers of the Totus Alpha Strategy, Ben McGarry and Tim Warner, will provide a recent overview of recent performance and their current views and thoughts following on from the recent corporate earnings season. Following their update, there'll be time for Q&A. Please submit any questions through the Q&A button at the bottom of your screen, or if listening in, email me at lps@totuscapital.com.au. We will attempt to get through as many of these as possible and finish within the hour. The webinar is being recorded and a link will be distributed and made available on our website following the session. I must say it is general information only and is intended to provide you with financial advice and has been prepared without taking into account your objectives, financial situation or needs. I'll now hand over to Ben to begin.
Thank you, Lisa. And welcome everybody to our semi-annual performance and business update, joined by Tim, my co-PM. Lisa gave you the agenda, so we'll just hop straight into it. Totus is an absolute return investment manager. I founded us back in 2012. We're focused on developed market equities and we are a long-short fund. The fund and the strategy was designed to maximise risk-adjusted net of fees returns to investors over the long term. Our objective is to preserve and compound our investors' capital alongside our own, regardless of conditions in the broader equity market and the economy. Underpinning our investment activities are these three core values. Integrity, we do what we say we are going to do. We're true to label. We focus on performance, maximising those net performance, risk-adjusted performance net of fees, not assets under management. And we're aligned. Our money is invested alongside our clients. Many of you will have seen this before, but we basically are a long quality, short, lower quality book. We like companies with tailwinds, economic moats, high returning businesses with clean accounts that are profitable, usually have strong balance sheets, a long track record of delivery, that are simple to understand, and we try to hold them for the medium to long term. We are short businesses and industries with headwinds in highly competitive sectors with low returns, dressed up earnings. We're often short unprofitable companies with poor unit economics. We like to short companies where the market has got carried away with the hype of a story. Complexity is often a good place to look for short opportunities, and we look for catalysts for the market to focus in on those business quality weaknesses. This slide just goes through our performance over the 10.5 years since Totus was launched. Our performance has been good. We've delivered 6.7% outperformance per year over 10.5 years, with only 37% net exposure to markets. So, achieving that objective of good risk-adjusted returns over time. What makes us different? Many of you will have seen this slide before, but our point of difference versus long-only funds and other Australian hedge funds and US funds that we compete with is that whilst we deliver reasonable returns in up markets, trailing the index on average in up markets, our point of difference is that we also deliver positive returns on balance in or on average in down markets. So when you put those two factors together, a slightly lower than market return on average in up markets, but also a positive return in down markets, you get a better overall return over the journey. This slide is one that I think is really worth focusing on. It shows our performance net of fees since inception back in 2012. The red circles highlight the 4 periods over that 10.5 years where markets have been volatile or gone down for an extended period of time. The first one was the European debt crisis. The second one was the wind down of the Fed balance sheet in 2015. and the commodities bust. The third circle there in 2020 was obviously the COVID, COVID fall. And the last one is 2022, which has been a difficult start for equities markets globally. And what this chart is basically showing is that the fund delivers positive absolute returns, or has delivered positive absolute returns in all four of those difficult periods for markets. Taking a step back, it also looks obvious to me after 10.5 years that in trending markets, the fund can perform and hold its own. 2021 was a good example of that, where markets were up 14%, the fund was up mid-20s. The area that is also obvious when looking at this chart that we need to do better in is performing after those periods where markets have fallen dramatically. The fund has outperformed. We need to do better at managing those snapback rallies in markets where risk-on periods where lower quality companies often tend to outperform higher quality companies for those short periods of time. And we'll go into how we're managing that. And we think we're doing a slightly better job of that in recent years than we did earlier on in the fund's life. Yeah, looking at some of those lessons, when we went back post the COVID fall, where we had an exceptional start to 2020 and gave a big chunk back in the second quarter of 2020, and looking back at previous episodes where the fund has had periods of underperformance in 2016, we're finding that that doing that post-mortem and coming away with some obvious adjustments to our portfolio management process or tweaks has really helped us so far in 2022. The key thing that stuck out to us when we looked at those periods of underperformance in Q2 2020 and the two drops in 2016 was that these periods of underperformance came after strong periods of outperformance during falling equity markets. The common theme when we looked at these drawdowns was that we came into them with high gross exposure. We hadn't been aggressive in taking profits in our short book, and we stayed net short for too long. With that in mind, it was pretty easy, or it made sense to make the following adjustments to our portfolio management strategy. After periods of strong outperformance in falling markets, we reduced our gross exposure. We did that by increasing our net exposure after markets have fallen, and the obvious way to do that was to buy back our shorts rather than adding to our longs. We attempted to do this in 2020, but we did it more with an emphasis on adding to our longs rather than taking profits in our shorts. And whilst our longs performed in that second quarter of 2020, our shorts outperformed our longs. And that was what led to that 3 months of underperformance. So the conclusion is that buying back shorts rather than adding to long positions leads to lower volatility and better performance outcomes, and it's certainly working so far in 2022. Yeah, giving you that update on performance, the fund, we're happy with how the fund's performed so far in a volatile year. At the end of August, we were up 9% net of fees in the flagship Alpha Strategy. The ASX 300, including dividends, was down 3.9%, and the MSCI World, which has obviously got a large weighting towards the US, is down a lot more, minus 17.8% as at the end of August. As a reminder, we have about 50% of our book exposed to Australian equities and 50% exposed to the US, so we're happy with that return. As you'd expect, looking at the chart on the right, it's been our short book that has delivered all of the return in a difficult year for markets. You can see a tick up in the long book in July, but yeah, the short book is doing what it should do and is protecting our investors' capital in a difficult market. Moving on to market observations. Now, my mum used to say no one likes a pessimist, and my experience has been that nobody really likes a realist either, but I'm going to call it how I see it as we go through these market observations. We're bottom-up stock pickers, I'll warn you that this presentation has a lot of top-down observations and lessons from financial market history. This helps us with portfolio positioning and gives us clues as to what parts of the market to focus our research on. It's been very helpful looking at financial market history in particular so far in 2022. Looking at reporting season, which just ended in Australia and the US, a key takeaway was that earnings were not as bad as feared, but that outlooks were cautious. It's important to remember that companies reporting in August are telling us what happened up to 30 June. We're looking in the rear view mirror when we're looking at reported earnings. One thing that stuck out to me was how many companies are putting up prices to offset higher labour and input costs. Often we're seeing companies put up prices multiple times in short periods of time, whereas usually they would do 1 or 2 price increases per year. You're seeing companies like James Hardie pushing through multiple price increases in a 6-month period. One of the other takeaways is that unprofitable companies are already doing it very tough. We're seeing an explosion of financial shenanigans, like using share-based compensation to pad out adjusted EBITDA, and the US tech sector is probably the worst offender for that. Looking at Australia and the US, companies on general are carrying high inventory balances. They're saying this is a hangover of the impact of supply disruptions, and they're carrying a lot of stock. But we've seen if demand slows, that carrying high inventory can be a big problem for profits. And we've seen companies like Target and Walmart take write-downs and profit warnings as a result of carrying too much inventory into a slowdown. We think that's a risk for the Aussie consumer discretionary sector moving forward. Another thing that we've started to see is companies raising capital or over-raising for acquisitions in order to provide a buffer against inflation or to fund an increase in working capital. That's something that Buffett talked about in the 70s as one of the main impacts of inflation, is that it costs more for companies to generate the same dollar of profit. So recently we saw Orica make a small acquisition and raise about an extra $500 million more than they were paying for that acquisition. And the reason given was to pay for increased working capital. Data was another one that raised capital just recently, also citing working capital as one of the reasons for the raise. It's obvious that the cost of living increases are already hitting the low-end consumer. Companies like Walmart are talking about consumers trading down from things like chicken to hot dogs and tinned meat. The low-end consumer is already cautious on big purchases. The high-end consumer is yet to see it. We were luxury goods, for example, the results were extremely strong. That's one part of the market that's yet to be impacted. The energy crisis or emerging energy crisis was one of the things that really was an eye-opener to us during the last reporting period. We met with a range of electricity generators, distributors, companies in the energy commodity space, and they're all seeing a difficult market over the medium to long term for energy. There doesn't appear to be any quick fixes apart from a very deep recession for the cost of energy, which is increasing almost on a daily basis. We're seeing layoffs starting to come through in Australia and the US, most notably in the US tech sector, but also in the VC space in Australia. We're seeing some Aussie tech companies, the likes of Domain, laid off workers just after the result. And we're seeing patches of other job market weakness in parts of the financial services sector, for example. The building industry is another one where we're seeing high profile business failures, and the housing market in the east coast of Australia is deflating, which is potentially a material risk for the Aussie consumer going forward. Before we go into market observations, I think it's worth just going back to where we've come from. We've just had a 10-year perfect storm or excellent environment for investing in equities. We've had extremely low inflation, which has recently spiked back to levels we haven't seen since the 1970s. Unemployment is also at record lows. Basically where it's at as good as it gets on the unemployment scene. Margins post-COVID are still extremely high versus history. Margins were boosted by record stimulus during COVID, a lack of discounting, and tax cuts in the US. And valuations, we've had some extremely full valuations for equities in recent times. These have started to come down and look a little bit more reasonable, but we're assuming that the earnings part of the valuation equation here, looking at PE, is correct. And our view is that there's still downside to earnings, and we'll go through why we think that in the coming slides. This slide looks at profit margins in the S&P, which has been a very predictable pattern of rises and falls. It's one of the most mean reverting data series you can get in financial markets. And you'll see that looking back to 2021, we had profit margins spike well above their long-term trend. As I mentioned, the stimulus and zero discounting tax cuts contributed to that, and they've started to roll over. As we look forward, it seems logical that higher labour costs, higher debt repayment costs due to higher interest rates, higher input and supply costs, the costs of adjusting supply chains to disruption, increased energy costs, and potentially the cost of clearing inventory will all lead to lower margins in the near to medium term. Taking this through from margins to earnings, we can see that earnings have also started to roll over. If we removed energy from the S&P results just reported, the rollover in earnings would have been more significant than 1.1%, but we've started to see this trend, which is also very mean reverting, starting to roll over. Earnings are cyclical and they tend to fall hard during recession. So when we're looking at valuation, you look at the price, but also the earnings. And we think that there's, looking at this chart and the margins chart we just looked at, that there's material downside to earnings. So valuations look reasonable as long as that E is okay. Yeah, looking at positioning, it's difficult. We could make a bull case or a bear case. There's a lot of conflicting data. We just pulled out two things that would suggest to us that positioning is not all that bearish. Looking at the left is it shows the holdings of Bank of America high net worth clients, and they're well above, well, they're close to all-time highs. That suggests that Bank of America's clients, at least, are still very long equities. Anecdotally, when we look at stock market commentary, talk to friends and family, neighbours, associates, and even look at things like inflows and outflows into growth funds, it suggests to us that there's still a very strong buy the dip mentality in equities, and equity holdings are still larger than they would be, through the cycle. The chart on the right is a good one. It's the Buffett indicator, which he's looked at over time as a napkin math way to look at whether or not the stock market is over or undervalued. And whilst we've come back from extreme levels, we are still at levels that we haven't seen since 2000. The napkin math that Buffett looks at is the ratio of S&P market cap to all publicly traded stocks market cap to GDP. So we're still at relatively high levels versus history on that measure. Okay, getting to the elephant in the room, which is inflation. We found this, there was an op-ed that Warren Buffett did in 1977 for the New York Times, and I think he summed up, the inflation problem for equities very well. He said, it's no longer a secret that stocks, like bonds, do poorly in an inflationary environment. We've been in such an environment for most of the past decade, and it has indeed been a time of troubles for stocks. He goes through in that article, the reasons why inflation is a tapeworm at the core of companies and eats away at profits. Tim's put an appendix in this presentation, which goes through a worked example of how much you need to put up prices to offset inflation. Lisa can send you a copy of this presentation after the webinar if you're interested. So what is this chart showing us? In the US, we've had 12 recessions in the last 75 years. 4 of them came between 1970 and 1982, which was the last time the US Federal Reserve tried to tackle an inflation problem. If we start on the left-hand side, the starting PE for equities in the late 60s was about 18 times. And by the time we'd had the 4 recessions and Federal Reserve Chairman Volcker had raised interest rates enough to get inflation back under control, the ending PE for the S&P 500 was 8 times. I think it's interesting because 18 times is roughly where the S&P earnings are right now. And this is why, when you look at this chart, we ended up with equities basically going almost nowhere except for dividends over the decade of the 70s. And it's why it's called a lost decade for equities. Which gets us to the next slide, which is one of the key bull cases we've heard for equities so far this year is that the Fed will always come to the rescue. And I think we're still very much in the camp that the Fed is not coming to the rescue anytime yet. We would put the Fed in one of the, if we had to put it in a bullish or bearish case, we would say that the Fed at the moment is bearish for equities. The reason for that is, they need to get inflation under control. They're very aware of the lessons of history, and Powell at Jackson Hole on the 25th of August was extremely clear about what his focus was as chairman of the Federal Reserve. The Federal Reserve has a dual mandate. They need to maximize employment and manage inflation through the cycle. At the moment, as we mentioned earlier, there is no unemployment problem. There are 2 jobs for every person that is unemployed in the US at the moment. So he has a mandate to focus on one issue only, and that is inflation. And when we look through this Fed speak, basically in the 3rd paragraph where he says, we need to bring softness to the labour market, and this will also bring some pain to household and businesses. That is basically central bankers speak for saying, we may need to cause a recession to get this inflation back under control. Going through some other reasons for caution. Well, when we start talking about recessions, we looking back, haven't been able to find a recession that was good for stocks. Looking at the recessions, whether there's soft landing or hard landings, when recessions are country specific, they're bad, but when they are broad-based and global, they are worse. And at the moment, we have lead indicators in most of the world's major economies are all pointing in one direction. Europe looks extremely tough. China is undergoing lockdowns and a material slowdown in construction. The developing world is under pressure due to rising food and energy costs. And even Australia and the US, we have deflating equity and housing markets at the same time. Which gets me to my 3rd point, multiple asset classes falling adds to the risk. Japan was really difficult because we had housing and equities, both starting from bubble territory. They had a lost decade when those bubbles started to deflate. This time we've got bonds coming off, crypto coming off. There's multiple points of pain in the asset markets. The energy crisis, is a potential wild card. Part of it is driven by the Ukraine conflict, which, an outbreak of peace would alleviate for a period, but a larger part in our view is driven by ESG policies and unsustainable low investment in replacing depleting fossil fuel reserves. So I think we've got, when you look at things like electricity prices, baseload power, it's the lifeblood of the economy, and there's no quick fixes on that front as far as we can see. This is the old market psychology chart, and that gets rolled out by bulls and bears alike. But I think it's useful just to think about psychology in investment markets and try to gauge where we are at the moment. History doesn't repeat, but it does rhyme, and human psychology is pretty consistent. So if we look at 2022, which is, we've had a sharp fall and a rebound. If I had to guess, I would say that the last time we spoke to you from San Francisco in our March webinar, we were close to denial, just sitting up there under new paradigm at the top. We've had a sharp collapse, which has woken everybody up, and we've had a very sharp rebound, which is normal in bear markets. And I think we're probably just on the other side of return to normal, which is, and the peak of that return to normal lower high in this chart probably coincided with Powell's speech at Jackson Hole on the 25th. Bear market rallies. This is the old chart of the 2000 NASDAQ sell-off. What this tells you is that bear market rallies are normal. I think we have 6 or 8 double-digit rallies that I can count in this chart on the way to a -78 over 3 years. Rallies in bear markets tend to be the most swift and vicious rallies, but this also tells you that bear markets, it takes time for markets to adjust to new information, for bubbles to deflate. We think what we just went through in July is a fairly typical bear market rally. Which leads us to our current positioning. As you can tell, we are cautious on equities. We're positioned for a continued downturn in equity markets. We're running lower than normal gross exposure and lower than normal net exposure to equities. This makes it easier for us to manage volatility. Bear markets tend to be quite volatile, and it means that if we're wrong-footed or we're wrong about being cautious on markets, there's less damage to our returns if we have less exposure to markets. Our game plan is to continue to cover shorts in sharp sell-offs. We have a wish list of 50, or a shopping list of 50 high-quality global and Australian market leaders in a range of industries that we're looking to buy, some of which we already have starting positions in, and we're planning to add, and we have been adding to those during sell-offs, and we plan to add to them in ongoing market volatility. And we're trying to stay open-minded. We're very alert to the bull case. We were wrong at the bottom of the sell-off in March 2020. I'm aware that there are things that could derail or could lead to new highs in equity markets. We can get to those in Q&A. We'll talk through them later. But this slide at the bottom, the chart at the bottom, shows our net and gross exposure for the Alpha strategy since inception. We've run an average gross exposure of 220%. We're currently sitting at 115%, and we've averaged a 37% net exposure since launch. We're currently sitting at 0. We haven't gone into too much in terms of single stocks, but this slide we talk through, an example of a long and short industry positioning. Undersupplied energy is a long for us. The reasons we think it looks good on the long side is that we, even in a recession, we need to heat our homes. We need to light our homes. Baseload power is essential to modern life. These are whether you're talking about electricity generation, mines, oil fields. These are scarce resources, not easily replicated. We've seen, due to ESG and volatility in commodity prices, that there is very, very limited funding for new supply. The current operators are generating billions and billions of dollars in free cash flow and are using that to buy back shares, return dividends to shareholders. With that kind of fire hose of cash, there's no need for them to dress up their accounts with accounting shenanigans. If you look at the balance sheets of energy producers at the moment, they're some of the cleanest accounts we can find in the markets. I mentioned returning cash to shareholders, and they are trading on, exceptionally cheap, low to single-digit free cash flow multiples. Double-digit free cash flow multiples and low to single-digit PE multiples. Comparing that, there's a sector we've made money on and lost money on in the past, but it's been a big contributor to returns this year. The buy now, pay later space, which was, a darling for equity markets in the zero interest rates, free money, 2020 go-go years. They've run into some, serious heavy weather as the cost of capital has gone up and the competition has intensified in that space. So these companies are economically sensitive. There's very, very limited barriers to entry. We saw PayPal spin up an offer, a feature on their service very, very quickly and immediately gain an enormous share of the buy now, pay later market in the US. Most of the listed operators are burning billions of dollars of cash. Many of them are paying an increasing proportion of their cost base is being met through share-based payments, which is highly dilutive to shareholders. We're seeing no evidence of operating leverage in the business models. As they gain new customers, the losses accelerate. There doesn't appear to be any leverage on fixed costs, which you would expect if it was a sustainable business. And many of these companies, whilst looking like they've fallen a lot in terms of the share prices, they're still trading on revenue multiples rather than earnings multiples. So we think there's potentially still downside in some of those listed names in Australia and the US. Okay, so given all that sort of doom and gloom, why stay invested? Well, there's great opportunities that come after asset price resets. And one of the reasons I set up Totus was to not just compound capital, but also to preserve it. And I've been lucky enough to experience two major market corrections in my career. And the aftermath of those corrections were two of the best investing periods that I've ever experienced. So we'll talk you through my experience in those two periods over the next couple of slides. Okay, just top down, we've talked about this with some clients face to face, but this is a little bit of a busy slide. But if you think about it, what it's showing, it is showing the realized 10-year returns for equities and what the employment rate or the unemployment rate was when you started those 10-year periods. And the red circles are basically showing that when you have low unemployment, the 10-year return for equities after periods of low unemployment are below average. We have a 6.4% return on average over the since 1950, if you invested during periods when unemployment is below average. Your best returns for equities, conversely, come when you are investing during periods of high unemployment. If you're investing post the 2000 GFC crash or post the US housing bust in 2008, 2009, when unemployment was high, your average 10-year return was 10.1%, which is well above average. So, which takes us to the far right of this chart. We are at the lowest levels of unemployment in Australia and the US, basically on record. So the odds or the maths say that Your 10-year returns, if you're fully invested now with unemployment very, very low, are likely to be below average. We would like powder dry to commit capital and get a lot longer when unemployment has spiked. This chart is just showing my age a little bit, but we've cobbled together the Totus Alpha Fund's track record since 2012. When we launched it, it's fair that it's not exactly an apples to apples comparison. There's a gap in the chart during 2011 when I set up Totus, but the dotted line is internal capital that I was managing that I used as I suppose, a performance track record in order, and also a way of getting capital together to start Totus Capital, and it encompassed the global financial crisis and the period after that. The first green line is that period from 2009 through to 2011, post the global financial crisis. On that, obviously pre-fee, unaudited internal capital track record. But the second line is our post-fee audited post-fee track record after the European debt crisis in 2012, which includes 2013, which was actually the fund's best year. It was a very strong year for markets, and the Alpha strategy performed very, very well in 2013. So whilst we've got a reputation as glass half empty, professional short sellers, there are, we have made money in bull markets, and we expect to be able to do so again when the opportunity presents. Looking at the bottom, I think it's worth looking at that current PE, again, 17.3 versus 14.8 when those strong returns in the long book were generated back post the financial crisis in 2013. The markets are still trading relatively expensive versus when those big opportunities came on the long side. And as we mentioned, we've got doubts about the E, so that PE could actually be higher than it looks in that table on the bottom right. Okay, well, we've sort of mixed our slides around. This is just an example of some of those high quality companies we're currently working on. We're looking at these and researching them, and the team's modeling them out. But also in addition to some of the names that we already have in our portfolio, the Microsofts and the Alphabets of the world, which we would like to add to in further market weakness. Okay, I'm also trying to end this presentation on a positive note, given a whole bunch of reasons to be cautious. I've been wrong before, as we talked about 2020. Hopefully we're wrong about the depth and duration of this equity market turbulence that we're experiencing. And look, I think the interesting thing about Totus over the 10.5 years is that whilst we've often been too bearish and often stayed too short, we've still managed to generate good risk-adjusted returns well ahead of market over the 10.5-year periods where a period where markets were performing strongly, markets up about 9% per year over the journey. And even 2020, when we were, we gave back all of that early performance in 2020 in that second quarter, we still managed to finish the journey from 1 January 2020 through to 31 December 2021 ahead of markets. And our performance, importantly, was delivered during very difficult periods over that journey when clients need it most. So an investment in Totus combined with investment in other long-only managers or long index tends to smooth out your returns and actually improve them over time, we hope. The big difference between those previous times where we were wrong and stayed too long bearish is obviously that they were periods of low inflation. We're now dealing with a period of high inflation, which markets haven't had to deal with for 50 years. We also always had the Fed put there, which was the backstop for equities over the last 10 years. And I think, unfortunately, we don't have the Fed in our corner backstopping equity. So that's one of the major reasons why we're still cautious at this time. I'll hand it over to Lisa for questions. Thank you.
Thanks, Ben and Tim. We'll now turn to questions. We received a few so far, but please continue to submit any questions you have via the Q&A button on your screen or email me directly at lps@totuscapital.com.au. We'll start with a question that was sent to us earlier. You seem rather bearish, but can you provide some examples of longs that you are keen on or any opportunities you're looking at?
I might throw this one to Tim, given...
Yeah, I'll give Ben a break from all his talking and all his bearishness. So on a positive note, we showed that slide before with some of those names on the shopping list that we're looking at. In general, we still think a lot of them look still quite expensive on an absolute basis, although cheaper than what they were over the last 2 years. And we're just, as Ben's been talking about, trying to stay patient in this environment. And on top of that, looking for resilient earnings with proven track records of free cash flow generation. So if we do go through a protracted drawdown, at least we can be comfortable in owning that business through it. So one name, I guess, that we've taken a small starting position in and fits into our digital transformation bucket is Adobe. A lot of you would know Adobe and be familiar with its software products, mainly Photoshop, which is part of its Creative Cloud suite. Adobe's software products are critical and essential tools for designers and creatives to perform their jobs, both for enterprise and as well as the freelance creative. What we like about it is that it's got very similar characteristics to businesses like Microsoft Excel, and also things like AutoCAD, which is provided by Autodesk, which was also on the slide. These businesses, the software they provide, it's essential to complete and perform your job, but they also you're trained on them during school and university, and they become ingrained into how you perform a task. So that leads to huge switching costs and network effects within the business model, which makes it hard to switch out of them. And from that leads to strong pricing power. And, in the Spence spoke about an inflationary environment, pricing power is critical to be able to pass prices on. And they're also very capital light business models and don't need external capital to grow. It's trading on 25 times consensus earnings, which, it's not absolutely cheap, but for the growth profile and the free cash flow generation that it provides, we think it's time to start buying a little bit, and in any further weakness, which might come from any pull forward in earnings from the COVID-induced stimulus and, people quitting their jobs and becoming a creative and using the software might not need it anymore. We think that might provide an opportunity to buy it at a cheaper price.
Yeah, sort of just add to Tim's that even when you strip out share-based compensation, they're trading on a reasonable free cash flow multiple. That share-based compensation is very reasonable relative to other US tech names, we've looked at and over the years. So there's a few reasons we like Adobe. Many of the names, we've talked about in previous webinars, the Objective Corps, the Smart Groups, the Prophecies and Shuros are still in the book. We have trimmed back some of our long exposure given the reduced overall gross exposure for the book and cautious outlook for markets. But we still own many of those companies we've owned for a number of years, just in slightly smaller sizes, or we've used inflows to reduce the position sizes. And then in the US, we still have exposure to some, high quality big tech names, the likes of Alphabet, the likes of Microsoft, albeit they're not as big as they used to be in a relative sense.
Yeah, and one more point I might add, we might be bearish overall on the consumer, especially in Australia, that we don't think that's hit yet. There are certain names in the Australian market, like a Nick Scali or a JB Hi-Fi, which we think are great quality retail businesses run by great management teams and have proven throughout this volatile period that they can manage their inventory well and their margins. They're things that we would like to add on the long side to offset some of our short exposure there.
Yeah, but we're still pretty much in the camp that we think we'll get a better buying opportunity later this year or early next year on those names.
Yeah.
Great. Thanks very much. In the latest earnings season, were there any particular standouts?
Look, yeah, I think Visa and MasterCard, which we own, were certainly extremely strong results. Travel has come back, quite aggressively, and that's the highest. The cross-border payments flows are the highest margin business for those two businesses. Obviously, to have a Visa or a MasterCard, you're middle to a higher income demographic, so their customer base hasn't been hit as hard yet by cost of living and energy price increases. So look, those results were very clean and strong. They're certainly not seeing any signs of the consumer slowdown. And one that we've been skeptical of in the past, didn't really understand the acquisition strategy, and have always sort of scratched our heads at the valuation is WiseTech, an Aussie software business in the freight forwarding and logistics space. Look, we couldn't pick any holes with that result and have moved on. Can't get there on the long side given the valuation, but certainly don't think it's worth a short position either. So WiseTech was a strong one in the Aussie market.
Great, thanks. Now a couple of questions around the positioning of the books. I've had a question around what's the current split between Australia and international or global stocks, and related to that, are you looking at potentially shorting outside of US and Australia, for instance, European industrials, given the energy crisis that's going to go on into the winter?
I'll take the first part of that and I'll throw it to Ben on the European stuff. So as we showed in the presentation, our net's running around 0% right now and our gross exposure about 120, which is lower than normal. On a geographic split, it's about 50-50 on a gross basis, with a net short tilt in Australia of sort of minus 10% and a net long offshore plus 10%. And that's no view on the different markets. That's just where we're finding the opportunities. And historically, we've tended to have more of the short book in Australia, as that's where the risk the book is, and we like to be in light markets. So that does swing around from time to time, but that's where it sits currently.
Yeah, Europe, we're certainly looking at it. Don't have anything major. We've had a small short position through a basket of European financial stocks. Obviously, financials are leveraged to economic activity, and economic activity is being depressed. One of the risks to our bearish positioning is government intervention. We've already seen a huge stimulus package put through the Inflation Reduction Act. I think Biden called it in the US, and in Germany we've had 2 or 3 rounds of compensation for consumers and businesses that have been impacted by higher energy prices. And then in the UK, the new Prime Minister is talking about tax cuts and handouts to offset cost of living. So, look, we did, the companies that you think might be most obviously impacted by a slowdown or by higher energy prices or a recession, if governments want to get really involved in, the COVID period showed us that they can distort the fundamentals of businesses for a long period of time. I mean, Qantas ended up performing quite well through COVID, despite having fleets grounded, etc. Wages got paid. They raised capital. Huge beneficiaries of government handouts. So, if we've been looking at Europe, indexes don't look like they've fallen that much. But when you look at them in euro terms, the euro has been collapsing, which means that the stocks in Aussie dollar or US terms are actually down a fair bit more than they look at a headline level.
Right. And have you got any thoughts on the Australian banks or financials, given rising interest rates and a potential housing price crisis crash?
Yeah, we have short positions in the Aussie banks. Definitely with East Coast housing prices coming off. dramatically, and the consumer, we think, starting to face material headwinds, and also small business as we head into the second half of this year and early next year. Our Aussie banks, great market structure, and but they are some of the most expensive banks in the world, and we think they won't be immune from a housing slowdown. They also have very, very large cost bases, and which will be impacted by higher wages and inflationary pressures. So yeah, it's difficult for us to see a lot of upside for the Aussie banks. The ANZ deal to buy Suncorp was seemed to be a huge head scratcher to us, but the stock rallied. CommBank, I think a lot of long only people are hiding, in CommBank, and it looks quite expensive to us. So yeah, if the economy gets worse, as I said before, the financials and the banks in particular are leveraged on economic activity, and difficult to see them outperforming in a recession or tougher economic environment.
Yeah, and I'll just add to that. We don't think it's like a GFC balance sheet risk. They're in really good capital position. It's more about the earnings trajectory, and demand generation for mortgages. You've got a whole bunch of fixed rates under 2%, which will be going to variable in the next 12 to 18 months at 6%, which will hit the consumer, and that impacts activity. And so that just leads to, whilst you might get some NIM expansion from interest rates going up, demand and volume is the biggest driver of the earnings, and that's where we see some impact.
Yeah, the fixed rate loans rolling off will create a huge churn event for the banks as everybody scrambles to get a better deal on their mortgage, and that's our mortgage broking industry will jump at that with both feet, and it's difficult to see the banks being able to hold on to a lot of margin expansion through that period.
And just to end off the session, a couple of questions around the firm or any changes. Have you had any changes to the team or the firm in the past 6 months or since the last webinar?
No changes. I'm pleased to say, there's 4 of us in research, Tim and I, PMs. We have 2 analysts, Hamish and Jack. It's working really well. We're covering plenty of ground for a small team. We're a research heavy organisation. So we've got Lisa running distribution and client services, and Sophia Sang, our CFO / head of compliance. So there's 6 of us full time at Totus. We have a part-time bookkeeper. Not a distribution, unfortunately, Lisa, organisation. We're a research, performance-driven organisation. So no changes over the last 6 months.
And how large is the Totus Alpha Strategy now?
Okay, you can invest in the Alpha Strategy 3 ways: through our monthly Aussie unit trust for wholesale investors. We have a Cayman version, which is pari passu, or invests alongside in the same stocks, but it's denominated in US dollars. It's for non-Australian investors. And then we have a daily unit priced retail PDS, which invests into our monthly fund. So there's 3 different ways to invest in the same strategy, and altogether, I think we're looking at about 185 or 190 million in total assets.
Great. Okay, well, thanks, Ben and Tim. I think we'll wrap up there because we've almost hit the hour mark. We'll respond to any questions that we're unable to get through this morning. Thank you for all those that were sent through, and feel free to reach out to any of us following the webinar. We appreciate you joining us, and thank you. Have a wonderful day.
Thanks, Lisa.
Thanks, everyone.